Good morning, everyone. Welcome to our new webinar series of Mehta and Mehta. This is the NBFC Knowledge Series, and this is the first webinar in this series. And today's topic is an insight into fair practice and governance code of NBFC Part 1. Friends, we as a Mehta and Mehta serve to the NBFC clients, and many times it was felt that one need to discuss, one need to analyze with others and work out, have discussion that what can be different views of different people, different companies, different practice followed up. And there it was lacking. There are unstructured way of doing. There are people on the Zoom call, phone, friends, and also WhatsApp group. People discuss continuously. But there was no structured platform where this can be discussed regularly, where everyone can share their view. Everyone can enrich with different people's views, ideas, and if required, even updation. And hence this thought of this webinar series. Friends, this is Mehta and Mehta's first efforts of sector-specific lockup plans. Here we are going to discuss majority NBFC compliance only. Every participants are allowed to share their views and share their knowledge and experience. We are going to start from today. Today topic is very big. So what we are doing is, today we are just discussing governance board and committee of NBFC. And we will discuss on certain practical aspect. Our so many panelists is there who are well known in the industry. And the fair practice code will take in the next session. So welcome all and thanks everyone for joining this. And we expect that more and more people will come and share their knowledge. With this, I'll start today's session and let me formally first introduce our panelist. And today's our panelist is for first session is Ms. Janani. And to introduce, welcome Ms. Janani. To introduce Ms. Janani, she is having a lot of experience. How humble she is. She has given a very short profile. She is a company secretary with 12 years of experience in secretarial and compliance function and has held key roles at Carborundum, Universal and Ashok Leyland and is currently serving as a DGM at Cholamandalam Investment, part of Murakkab Group and upper layer NBFC. Welcome, Ms. Janani. We have with us moderator, Mr. San, and San, to formally introduce, he has been regularly in our Saturday other webinar series, which every Saturday we. Sam is a holds master's degree in LLM, fellow member of ICSI. He is insolvency professional, PG postgraduate diploma business administration in finance management, Indian Institute Banking certified professional in NBFC profession, CAIS certified CSR professional, and he is having more than 24 years experience in compliance, legal, governance, secretarial domain. He has many things, but presently with Coromandalam International Limited as a senior associate vice president and company secretary and compliance officer. Welcome, Shan.
Okay, thank you.
With us also another moderator, with proud I can say, he is ex-Mehta. Hemant Pandya, Executive Director, Compliance, Legal and Secretarial. Mr. Hemant has around 18 years of rich experience across the entire spectrum of corporate secretarial compliance and legal functions. He started his career in 2007 with JM Finance Group, where he currently designated as Executive Director, Compliance, Legal and Corporate Secretary. He was for a short stint with Mehta and Mehta, and he has experience in MNC for handling the work of MNC, FMCG and financial sector. He is a BCom LLB, and qualified CS, and currently he serves as a company secretary compliance officer of GM Finance Limited, flagship company of GM Financial Group. He is also compliance and secretarial function of various subsidiary of group, which include NBFC and Housing Finance Company. Welcome, Mr. Hemant. Thanks a lot. Today's our presenter is Ms. Sakshi Gupta, partner Mehta and Mehta Jaipur branch. And we have with us Ms. Alifia Sapatwala, who holds our NBFC practice in Mehta and Mehta. With us, Sudhakar Sarvatullah. Friends, no one needs his introduction. He is having several years of experience. He is a qualified CA, CS, and also member of CS Institute of London. And he is having several years of experience in secretarial compliance. And last, he was holding the position in Reliance Group. And he is the chief consultant of Mehta and Mehta. With this, let's start. I'll request Ms. Shan to say a few words on topic, Mr. Hemant, then Sudhakar, Alifia, if you want to say, and then Ms. Jenny, and then Sakshi, you can start. Over to Mr. Shan, please.
Yeah, good morning to everybody. I thank you, Mehta and Mehta, for organizing a webinar on this very important topic. As you all may be aware, NBFCs are one of the important pillars in the financial ecosystem. And over the years, the regulatory purview of RBI on NBFC has immensely increased. I can say that the regulatory arbitrage between the banks and NBFCs has been narrowing down to a lot of extent, and it's almost on par with the banks, if not equal to the banks. And last couple of years, there have been a lot of the regulatory changes in the NBFC sector, which impacted many of the NBFCs, and new categorization have been brought in by RBI, in terms of their asset size and all that. So this is a very important topic for everyone who's handling the NBFC compliances. I hope this webinar will prove to be useful. Thank you. Thank you. Over to you, Ms. Deep.
Over to Hemant, please.
I agree with what Shan said. It's a very nicely arranged seminar need for the hour by Mehta and Mehta. So RBI guidelines are very different from other regulations. If you see RBI guidelines are they will just give you these are the broad things. It will not say you can do this, you cannot do this. It's up to you how to interpret and you to understand what regulator wants. So it's a very different ball game when you are a compliance officer. To understand what regulator will think. You have to think being in the business, you have to think from the regulator point of view and advise your business that this is how regulator may think and this is how we should do. So it's a very different ball game, and RBI has recently very nicely given emphasis, and even SEBI and all other regulators, on compliance officer. So we as a company secretary has a very good role to play on this thing, and I appreciate Mehta and Mehta bringing out this series. I believe it will benefit to everyone.
Thank you. Sudhakar and then Ms. Jenny, because we are running late. So Alifia, I'll give.
I think Deepti, considering the time factor, I won't say anything. That while Sakshi is making her presentation, we can engage in.
Yeah, Ms. Jenny, please, and then Sakshi.
Yeah, firstly, thank you for this opportunity. As my other fellow panel members also rightly pointed out, over the years, NBFC has become an important intermediary in the financial ecosystem, and which is also reflected in the way the NBFC regulations have evolved. To this extent, I feel this NBFC series is critically important for us so that we all engage and learn and make the best out of it. Thank you for organizing this.
Thank you. Sakshi, you start sharing the screen. And friends, from next session, we'll start from 9:30. And we'll try to reduce, since it was first session, we had little more introductory, we'll reduce to crisp it so that your time is saved. Yes, Sakshi, start.
Good morning, everyone. Welcome to our very first session of NBFC Knowledge Series. So today we are going to discuss about the very basics of the NBFCs. In that, so first of all, I'll start with what is NBFC. We all know it's a non-banking financial company. However, every company needs to be registered with the Companies Act, under Companies Act with the MCA. But the companies which are engaged in the financial activities of the lending, investments, and other related services, but are not the banks, would be the NBFCs. So, to get NBFC registered with the RBI, we have to get a 50-50 test wherein the financial assets of the NBFC should be more than of its 50% of the total assets. And along with that, income from those financial assets should be more than 50% of its gross income. If a company is passing this 50-50 test, then it has to be registered with the RBI as an NBFC. Other than that, if it is not passing a 50-50 test, the companies cannot be registered as an NBFC with the RBI. It would be a company under the Companies Act. Then in this session, we will be discussing about the governance guidelines, which has been covered under the scale-based regulations of the RBI. So it is going to be a very basic session. So governance is a very important part of any company for that matter. But for the RBI regulated companies, it becomes a bit more stringent. So to start with, first I will discuss about the layering of the NBFCs. So RBI has bifurcated NBFCs into multiple layers depending on this asset sizes. So first is the base layer, wherein any NBFC which is non-deposit taking, having an asset size of 1,000 crore or below, would be considered as a base layer NBFC. Whenever the 1,000 crore threshold is crossed by an NBFC, then it covers into the middle layer NBFC. And other than that, there is an upper layer NBFC wherein the top 10 eligible NBFCs of the country, irrespective of their asset size, will be falling in the upper layer NBFC. There is one more layer which is called as the top layer. However, that remains empty generally because it is up to the RBI. If they feel that there is any NBFC which is required to be in the top layer, then only it would be considered in the top layer of the NBFC. Other than these asset sizes, there are certain other kind of NBFCs which will always remain in either in the base layer or the middle layer, irrespective of their asset sizes. For example, the peer-to-peer lending platform NBFC, NBFC account aggregator, non-operating financial holding companies, or NBFC not availing public funds and not having any customer interface would be always considered as the base layer NBFCs, irrespective of their sizes. Then we have any NBFC which is taking deposits, NBFC standalone primary dealer, infrastructure debt funding NBFC, core investment companies, housing finance companies, and the NBFCs in the infrastructure finance company would always be considered as the middle layer NBFCs, irrespective of their asset size, whether they are below 1,000 crore of their asset sizes. And by bifurcating these NBFCs into the base layer, middle layer, and upper layer, the only difference is that the compliances. The moment the layering starts increasing, the compliances also start increasing for the NBFCs. Then first we will understand the governance guidelines for the base layer NBFCs. These guidelines needs to be followed by all NBFCs, whether they are base layer, middle layer, upper layer. So these are the basic guidelines.
1 minute up.
Yes, ma'am.
Panelist, whether we will take question parallelly if relevant to that area. Because in chat box there is a question. Shall I take it now or at the end we will take?
I think you can take simultaneously, Dipti.
Yeah. So the question is whether both conditions, financial assets and income, needs to be fulfilled for NBFC registration. Whether registration is mandatory if only one condition is fulfilled.
Both the condition needs to be fulfilled.
The conditions are required.
And she mentioned that where your both conditions are not fulfilled, only one condition is fulfilled, no need of registration. Then she mentioned that it is a company under Companies Act, not a registration under NBFC. Yes, that's good.
So under the governance guidelines, we all know that a company requires to have a board of directors. However, for an NBFC, the experience of board really matters. So at least one of the director of the board of an NBFC needs to have a relevant banking or an NBFC experience. And these are all mandatory guidelines for the NBFCs. Then all the NBFCs, irrespective of their sizes, needs to constitute a risk management committee, because in the Companies Act, risk management committee has a different threshold. But if a company is having very less shareholding, still they need to have a risk management committee if they're an NBFC, because for the NBFCs, prioritizing the risk management is absolute paramount. Now, there are certain restrictions or the requirements for the loans to directors, senior officers, and relatives of the directors for the NBFCs. And I would say,
sorry, there is another question.
yes, ma'am.
Whether foreign companies can be registered as NBFC? Means basically FDI. So you will set up a subsidiary in India, 100% subsidiary, and set up NBFC, FDI guidelines.
Yeah, that is possible because many
Yeah,
of the
only
NBFCs,
I think investment limit is there for that.
yes,
Exactly. If I am not wrong, if that subsidiary of a foreign company or associate of a foreign company, if it is a company incorporated in India, then definitely if it is carrying on any kind of finance related business, it has to get registered with RBI. Suppose
Yeah.
if it is not a company, if it is only a branch office kind of thing, I don't think that it has to get registered as a NBFC company with RBI. It may
Yes,
have to
ma'am.
comply with the RBI guidelines, but it need not get registered as an NBFC company. If I am not wrong, to my knowledge, to get registered as an NBFC company, it should be a company first. Then only it can be registered as an NBFC company.
And
Right.
but you cannot carry on activity as a branches. You are required to be registered as NBFC.
That's what I said.
NBFC.
RBI guidelines have to be complied. NBFC guidelines are different to that of those other guidelines.
And there is a threshold for in the sense the minimum investment in foreign if you want to register NBFC as a foreign. Yeah, but you can do it.
So now the loans to directors, senior officers, and relatives of the directors. So this is a very, I would say, is a point where a lot of NBFCs get stuck and RBI is issuing a lot of penalties. So it is quite serious in those terms that NBFCs are required to put up board approved policy for granting loans to the either directors, senior officers, or their relatives, or the entities in which their directors or their relatives have a major shareholding. So that particular policy is required to give a threshold limit, which would be the maximum threshold that the loans can be given to those people. More than that cannot be given. And along with that, they are required to give the disclosures in the annual financial statements, stating the aggregate amount to which loan is outstanding at the end of the financial year, the percentage of the loans in terms of the total loan portfolio of the company, or if there has been any instances of default or delay in repayment pertaining to such loans by those directors or their relatives. Also, in the annual financial statements, it is required to be, the bifurcation needs to be given, how much loan has been given to the directors and their relatives in the current year as compared to the previous year, in the entities which is associated with the directors and their relatives, and the senior officers and their relatives of the company, the loan given in the current year as compared to the previous year. Now we will discuss.
Just a moment.
Yes.
A couple of points here. Here there is a threshold limit for the loans in this regard. I think up to 5 crores, you'll have to report to the board. More than 5 crores, you'll have to take the approval of the board or the committee if the powers are given to the committee. And of course, apart from this, the company has to ensure compliance of 185 if it's an ordinary course of business, and then again, interest as specified in 185 is charged, then it gets the exemption. And of course, another point is if it is an RPT, you'll have to comply with the RPT regulatory aspects as well. And the provisions, the guidelines in this regard not only covers the loans and advances, but it also covers contracts. That is one important point you will have to remember. Suppose if there is any contract of sale or purchase with the employees, directors, or with the senior officers or directors, and that also gets covered under the guidelines. Over to you, Sakshi.
Yeah, just to add to what you had mentioned, this is predominantly applicable only from the middle layer.
Base layer also, I think there is a
Base layer talks
requirement to
about
have a
the board
policy.
approved policy. Yeah, it is
Yeah.
there from the
Middle and upper layer, it is applicable.
middle layer and applicable.
So now we will discuss about the appointment of statutory central auditors or the statutory auditors in the NBFC. So there are certain requirements for that. If the NBFC which has the asset size of more than 15,000 crore, then they at the end of the previous financial year, then they mandatorily appoint joint auditors, at least comprising of the two audit firms, which could be either partnership firm or LLPs. For the other NBFCs, which is below the size of 15,000 crores, they can have only one audit firm as well. So the joint auditors, what we talk about here is the main important point is that we cannot have the common partners. The two other firms which is being mentioned here, they cannot have common partners or in the same network of the audit firms. If that is the case, they would be construed as a single uh, audit firm only. They cannot be considered as the two separate firms. So as we discussed that the NBFCs are required to have their board or the local management committee can have a approved policy regarding the appointment of the statutory auditors for the for the NBFCs having the asset size below 15,000 crore, minimum requirement is a one audit firm. However, if the company feels, considering their size, their number of transactions, they want to have a two audit firms or the three audit firms, they can do that. But for that, they need to have a board approved policy, or the board should decide on the same.
So actually, you have covered local management committee letter in the part of presentation.
So, ma'am, with the committees, how are we discussing it is as in when it is coming with the topic, we will be covering
Because
the
here it is covered, no? That's why I'm
this
okay.
one. So there
Just
is a
want to
certain
add one thing, with respect to auditors. So RBI, treats auditors as a very important party to the system, entire system. So when it comes to statutory auditors, when they come for inspection, generally they see, how company reviews the statutory auditors, appointment, reappointment. Even if you are appointed for 3 years, how was their performance, during the entire year? We have to review it. We have to ensure that it's a properly documented this thing, even if it's not mentioned in the regulation, but RBI insists that the review is done properly, and RBI has access to the statutory auditors. They may directly call the statutory auditors at any point of time, and they may take the view how company is performing. So statutory auditors plays a very important role in the entire system. After that follows the internal auditors, but statutory auditors plays a very important role. And this is how there's a difference between 5 years and 3 years. You can appoint only statutory auditors for 3 years in NBFC vis-a-vis the Companies Act.
They are termed as a intermediary between regulatory and the industry, where both they can check whether how the company's compliance level and all that. So auditor, they will take the filler. Yes, sir.
Yeah. So there is a certain eligibility criteria which has been given by RBI for appointment of a statutory auditor. So for the companies having asset size of 15,000 crores, as they are required to have joint auditors. So for that as well, they need to find a firm wherein there should not be, should not be in the same network or having the same partners or the common partners in the firm. So there are certain requirements like the minimum number of full-time partners should be five, at least five, for the as companies having asset size of more than 15,000 crores. For the companies having asset size between 1,000 crore up to 15,000 crores, the minimum partner should be three, and up to 1,000 crore, the only two partners can be suffice. Accordingly, for the minimum number of fellow chartered accountants associated with the firm for at least 3 years should be four in case of NBFC for more than 15,000 crores. Then 2 in case of 1,000 to up to 15,000, and up to 1,000, only one FCA can be suffice for that. So basically for this, all the NBFCs are required to consider this criteria, which has been given in scale-based regulations of RBI before appointing any firm as the statutory auditors of their NBFC company. Now we will discuss more about the tenure and the rotation of the statutory auditors. As Hemant sir said, that is correct, that NBFC can appoint statutory auditors for a period of only 3 years, subject to their annual eligibility. And in case of the removal of the auditors before their term, then a prior RBI approval is required in the case of banks and the UCBs. However, in the case of NBFCs, they are required to inform RBI with the reasons within 1 month. If a firm's tenure is complete as a statutory auditor, they are ineligible to be reappointed for the next 6 years. That is the 2 tenures. Though they can audit the other entities, however, they cannot audit the same company. So there are certain requirements on the audit firms as well from the RBI, that they can do only 4 commercial banks, including 1 PSB or 1 AIFI, 8 UCBs and 8 NBFCs for the in 1 year for the statutory audit.
In fact, the change in auditors has to be planned well in advance because of these tenure restrictions and cooling off period. Sometimes NBFCs will find it very difficult to get some, auditors who have good background of experience in NBFCs actually. And they also have certain restrictions in terms of the number of banks and NBFCs they can register. So it's critical that the companies plan well in advance actually.
Yeah, and there's one more requirement as well, which says in case the auditor or the chartered accountant firm has provided any non-audit services, then it necessarily needs to be a gap of a year prior to their appointment. I mean, cool off of 1 year. So that is also a critical requirement when NBFCs are planning for the auditor change.
So it is very important even during the tenure, if an auditor becomes ineligible, the company needs to approach the RBI for a change in auditor. So the eligibility condition is very important. The companies need to monitor it during the tenure of that particular auditor.
Yes, Sakshi. Go ahead. Thank you.
So now after that, the acquisition and transfer of control of NBFCs, which is that for this, a prior approval of RBI is required in case any takeover or acquisition of control of the NBFC is happening, which is resulting in more than 26% or more. So in case if the 26% more than 26% change is happening, which is due to buyback or reduction of capital approved by the competent authority, then the prior approval is not required. However, same is required to be reported within 1 month to the RBI. Then in the change in management, which is that change in directors of the company, if it results in more than 30% change in management, then the prior approval of RBI is required for that same. If the change is not more than 30%, prior approval is not required, but needs to be communicated to RBI within 1 month of the change. And in the case of reappointment of directors on the retirement by rotation, then no prior approval is required for RBI.
In case of unlisted NBFCs, one have to be careful on interstate transfer between promoters as well. If there will be change of 26% or more, though these guidelines does not cover specifically those aspects.
So here, sir, I want to discuss about one thing. So this 26% or 30%, are we discussing that only a one-time change, or it is like once the RBI has approved certain transaction and the multiple changes which is considering as 26% would be considered yours?
My understanding is that every time there is a change of 26% or more, you will have to go to the RBI to seek its prior approval. That's what the guideline says.
This guidelines are very important guidelines. When 26% change, which is to be considered. Even conversion of CCPS to equity, RBI treats it as a change in the percentage. The CCPS is going to get converted into equity, but RBI for them, there would be a change in equity. You have to take approval. So this is how stringent RBI is in with this thing. You have to be very clear while ensuring that the compliance of this, because this can lead, if something non-compliance can lead to a lot of big problem to the company.
So before issuance of CCPS, you require approval?
No,
But
won't require approval.
But at the
Yeah.
time of conversion, before conversion, you require.
Yeah, at the time of conversion, it will change to equity. That's the
Right.
reason if it exceeds 26%, then you have to take the approval of RBI and get this thing.
Now here the catch is, if RBI do not give, you have timeline. You have to convert.
According to me, before issuing CCPS, you have to take RBI approval.
Because
Though it is not mandatory as such, but tomorrow, as you rightly said, Deepti, suppose at the time of conversion, suppose that, for example, they are not refused it, but they are not giving you the approval. In the meantime, that conversion has to take place. How you will deal with the situation?
So have you faced this kind of, with your experience, that it get delayed or not given kind of thing? You faced any one of that, or anyone has faced it in the participants? Or generally they give it as such?
See, that in fact, of course, not in case of equity, but in case of change in the directors. If it is going to be a change of more than 1/3, okay, 1/3 or more, in fact, you have to get the prior approval of RBI. We were having one NBFC company where we were having only 3 directors, which was a public company. In the 3 directors, one director has resigned, and we cannot appoint the third director because it amounts to 1/3 or more. Unless until we have the RBI approval, you cannot appoint the third director. And we have applied, but the approval was not coming. In the meanwhile, we were actually flouting the Companies Act provisions, and we went for voluntary compounding in that case. After that, what we did was we have ensured that wherever we have public companies or private companies, it is always better to have one director more always, rather than having that minimal number of directors. So you cannot take that RBI for granted that they will give the approval to you. Sometimes they may not give the approval for whatever the reasons it is, or sometimes they may even delay the things also. But to a large extent, as a regulator, my experience with RBI is more pragmatic and practical than of the other 2 regulators.
There is a comment from the participants that you need to take prior approval. You need to take prior approval from RBI, considering CCPS conversion into equity more than 26% at the time of CCPS issuance itself. Ms. Monica has given the comment. Okay, thanks. Thanks, Ms. Monica, for your inputs. Yeah, go ahead.
So for the application for prior approval for acquisition and transfer of control with the RBI, the NBFCs must apply on the company's letterhead along with the details of proposed directors or the shareholders, as it is given in the Annexure 12 of the scale-based regulations issued by RBI, the sources of funds of proposed shareholders, and declaration confirming that nobody is associated with any unincorporated body accepting public deposits. They're not linked to any company whose COR application was rejected by RBI, and there are no criminal cases, including under Section 138 of NI Act. And the bank.
There is a question that from Ms. Rupa. My company has equity capital of rupees 7.5 crore. We are proposing to do a preferential allotment of 8 crore. Do we need to go for prior approval, even though not a single allotee is getting 26% post-issue holding? Over to panelist. Shall I repeat? My company has equity
No,
capital.
Dipti, the answer to that is if there is a change in the control because of that preferential allotment, what they are doing it, if that amounts to a change in the control of more than 26%, yes, they have to have prior approval of RBI. But if that preferential allotment is not indulging in change of control, it's not required.
Yeah,
The words used are change in shareholding,
Same thing.
representing that percentage of voting rights. So,
Correct.
yeah.
That's what I say.
So you can say that if more than 50% of the shareholding is getting changed, it is change of control. We can put that way.
Oh, it's 26%.
26%.
26%
So it
change
is change of control of 26% of your total voting power in the company.
Yeah.
So then you require a prior. Forget about your amount. You have to just say what is 26% of your total shareholding. If it is changing, you have to. Yeah. Sorry, Sach. Go ahead.
So in case of change in control or the management, there are a requirement of prior public notice about that particular change. So no public notice of at least 30 days in advance must be issued before effecting any sale, transfer of ownership or control with or without share sale. The notice must be given after RBI's prior approval by the NBFCs, the other party, or jointly. The content of the notice should include the intention to sell or transfer the ownership or control, details of the transferee, and reason for that particular transaction. And it needs to be published in one leading English newspaper and one leading local vernacular newspaper. Now, investment from FATF non-compliant jurisdictions. In case of that particular transaction, if there is a new investment from a FATF non-compliant jurisdiction, they are not treated at par with compliant ones. So they can any investors from those particular jurisdiction cannot acquire a significant influence as per the accounting standards, and the aggregate holding, either directly or indirectly, should be less than 20% of the voting power. For the existing investors, if they fall in the FATF non-compliant jurisdiction, they can carry on holding the shares before classification of being non-compliant. However, for the additional investments, the requirement of these 20% should be followed. In situation wherever the NBFC is closing their branch, they are required to issue a public notice, which is like at least 3 months before closing of any branch. They should issue a public notice in one leading national newspaper and one leading local vernacular newspaper. And the notice must specify the purpose of closure and arrangements made for servicing depositors and other stakeholders. So here I would like to add one more thing, like whenever there's a requirement of issuing a notice in a vernacular newspaper, the particular notice should be issued in that vernacular language. The purpose is that a lot of companies, what they do is they issue the notice in the vernacular language newspaper, but they issue that particular notice in English language only, which is wrong. So if there is any particular change in the NBFC, their directors, addresses, or the auditors, that all the changes are required to be addressed to RBI within 1 month of that particular change. If there is a change in the address of the registered office or the corporate office of the NBFC, if there is a change in the director and their residential addresses of the directors of NBFC, the change in the change of the principal officers, the name and the address of the office of the auditors, or if there's any change in the specimen of the signature of the authorized signatories as well. All these changes are required to be addressed to RBI within 1 month of that particular change. Now, the additional guidelines which are required to be followed by the middle layer NBFCs, we will be discussing that now. So the ones we have discussed, which needs to be followed by all NBFCs irrespective of their sizes. Now these are specifically for the middle layer NBFCs.
Before we go to middle layer, and I would like to add one more thing here. There is a concept of multiple NBFCs in the same group. So there may be a group which has a lot of NBFCs, three or four NBFCs in the group. The asset size may be less than 1,000 crore of each of this NBFC, but you have to club this amount, the asset size of all the NBFCs, and if it exceeds 1,000 crore, then all the NBFCs will be treated as multiple middle layer NBFC in the group, and not and they will have to follow the middle layer guidelines in the group.
Thank you for inputs. Yeah, sorry.
So before we move forward, so I would like to say that there are certain committees which are required to be constituted by the NBFCs. As we have discussed that risk management committee is required to be constituted by all the NBFCs irrespective of their sizes. So now for the middle layer NBFCs, there are certain other requirements which needs to be followed. So we will discuss, we'll be discussing about those committees in detail wherever they come in with our presentation. So first we will start with the audit committee, which is required to be constituted in the for the middle layer NBFC. So all the requirements of this audit committee needs to be adhered to as per the Companies Act regulations. However, the certain additional things would be that the recommendation for appointment and remuneration in terms of all the auditors should be by the audit committee. They should review and monitor the auditor's independence and its performance. Financial statements and auditors' reports needs to be examined. The additional thing is that the audit committee is required to ensure that the information system audit is being done by is conducted at least once in 2 years to assess and mitigate the operational risk by the NBFC. It is the responsibility of audit committee to ensure that happens in the NBFC. Then NBFCs in the middle layer are required to also constitute NRC committee. So
can I add something in audit committee if time allows?
Sorry.
Can I add something for the audit committee? So, to all the participants, audit committee, generally management sits in the audit committee, right? And they discuss, audit committee may have questions and management MD will answer those questions. But RBI is a regulator which insists that, the audit committee should be without the presence of management. MD should not be a part of the audit committee. He should not be participating in the audit committee. So, but that's really difficult. So what many companies does is, they give a separate time for the audit committee where there is no management sitting in the committee itself, and the audit committee discusses, reviews the performance of the management. If they have anything, they do it. So this is something very different because there are a lot of observations by RBI that, your managing director participates he sits in the audit committee, which RBI doesn't like. So this is one practical, how RBI thinks.
Oh, great. So it's like independent directors committee in Companies Act where no other management is there. And of course, the way out is that like other companies does before board meeting, there is always a meeting and then board meeting happen. That way you can work it out.
It's an invitee also.
Yeah, what RBI officials say during the inspection is that they can be invited on a case-to-case basis to address queries. They should not be sitting in the whole meeting. That is what is their expectation. And as supplementing what Hemant was saying, that internal auditor is also expected to have a separate meeting with the audit committee members. So those deliberations have to also to be maintained and to be given during the inspection.
So I can say that this facilitating the audit committee and the internal auditor and audit committee, because they have a lot of responsibility and the RBI expect lot many things from them. So if there is a provision, they at least can exercise this right. Otherwise, it will be difficult for them.
The committee should have a fair view. They should be vocal. Yeah. They can discuss independently. That's the reason, they without any fear of management.
Right. Thanks.
The other committee which is required to be constituted by the middle layer NBFCs is the Nomination and Remuneration Committee. wherein they should have at least 3 non-executive directors and half of them should be the independent directors. The chairperson of the audit committee, the chairperson of the committee can be the member of the NRC committee, but cannot be the chairperson of that particular NRC committee. So the major functions of NRC, which has been given by RBI, is that they are required to identify a person for being appointed as the directors and the senior management of the NBFC, and they should recommend their appointment or removal to the board. And they are required to do the performance evaluation of the board, committees, and the individual directors. The evaluation must be carried out by the board, NRC, or an independent external agency. They should review the implementation and compliance of the evaluation process.
One of the
NRC should also
important thing RBI expects during the inspection is that the NRC should review the succession planning regularly.
Yeah.
That is something which RBI critically looks at during the inspection process.
And besides that, one major requirement is that NRC should evaluate whether the directors are fulfilling the fit and proper criteria while the appointment is being considered. That is a
The
critical.
NRC chairman is expected to sign that.
Yeah, NRC chairman is expected to sign that declaration and it's submitted to the RBI within 30 days. And also the compensation of the KMPs needs to be, while it's also a requirement under the Companies Act that the compensation of KMPs and, senior management and directors are to be reviewed by the NRC. RBI also expects that this compensation is aligned with the risks emanating out of, risks of the company. So that is also a very critical requirement that RBI prescribes. So it
There's a
should be
question.
adjusted against all types of risks. And in terms of risk outcomes, it needs to be appropriately aligned.
There's a question, but Act asks to have majority independent director as a member of audit committee. So for 3 members in audit committee, 1 can be of management and that 1 can be MD. Is there any provision restricting MD cannot be member of audit committee?
I think Hemant has already addressed that. Saying
Yeah.
that he is not going to have management people in the audit committee.
Yeah, go ahead, sir.
So
Given
it is very
that
important for
something-
the management of the
Sakshi, 1 minute.
to ensure
sorry.
that all the 3 regulations, so it is RBI, Companies Act, or LODR, everything has to be complied with for a listed NBFC. So there are 3 regulators and the provisions have to be complied with. They are overlapping each other.
Yeah, right. Yeah,
And
Hemant, you were saying.
policy of NRC, RBI has, also introduced something that, what should be there in your policy. So it says, there should be something called as clawback also clause in your NRC policy. So which is nowhere, in other guidelines, but here they are specifically as there should be clawback clauses in your policy, a lot of things should be covered in your policy. A lot of things are given in that.
Yeah, Sakshi, go ahead.
So RBI requires NRC to do some policy formulations. For that, they are required to frame the criteria for the qualification, positive attributes, and independence of the directors. They are required to recommend a remuneration policy for the directors, KMP, and other employees. And remuneration should be reasonable and sufficient to attract and retain top talent, linked to the performance and appropriate benchmarks, and balance between fixed and incentive pay to reflect short and long-term goals of the company. Yeah. So there is also a requirement of appointment of CRO, which is mandatory for the NBFCs having asset size of more than 5,000 crore, and NBFCs being ICC, NBFC IFCs, NBFC MFI, NBFC factors, and IDF NBFCs, they are required to appoint the CRO in the company. It should be a senior official with relevant professional qualification and must be appointed for a fixed tenure with the board's approval. Premature transfer or removal of the CRO requires the board approval and must be reported to RBI. And if NBFC is a listed NBFC, then the changes must be reported to the stock exchanges as well. And the CRO is required to function independently with no business targets or dual responsibilities. RBI does not allow dual hatting over here. And The CRO shall not have any reporting relationship with the business verticals. He should be a specific into the risk-related functions of the NBFC. He should directly report to the MD and CEO or the RMC committee of the board. If he is reporting to MD and CEO, then he must the RMC committee or the board must meet the CRO quarterly without the presence of MD and CEO of the company. So CRO's major roles and responsibility involves the identification, measurement, and mitigation of all material risks. All credit products must be vetted by CRO from a risk perspective. He should have a role in credit proposals is advisory only, unless part of credit sanctioning committee. There is a credit committee role wherein if the CRO has voting rights in high value credit sanctioning, and all committee members are individually and severally liable, including for risk considerations. Then, as we discussed, there needs to be a fit and proper criteria for the directors. So before appointment of any directors, our NBFCs are required to do a proper due diligences of those candidates for being appointed as the directors, and they should assess on the basis of their qualification, technical expertise, track record, integrity, and other fit and proper criteria should be done at the time of the appointment and the renewal as well. So they are required to obtain a declarations in the prescribed format by NBFC, by RBI in the skill-based regulation in the appendix from the existing or the proposed directors, and the annual disclosures as on date on 31st March should confirming that there is no change or disclosing any updates in the fit and proper criteria of the directors should be taken every year. So NRC must scrutinize the declaration and assess that suitability of the individual to be appointed, proposed to be appointed as the director, and the final decision on the appointment is the proposed director lies with the NRC based on the due diligence being conducted by the company. Board also ensure that the deed of covenants is being executed by all the directors. Then NBFCs are also required to appoint the key managerial personnel, which has been same as per the Companies Act. So the KMPs of the middle layer or upper layer cannot hold office, including directorships in the other middle layer or upper layer NBFCs, except the subsidiary of the NBFC. However, they can hold directorship in the base layer NBFCs. So there are certain criteria for the independent directors as well. The independent directors can be on the board of maximum 3 NBFCs. So NBFCs here would be considered only the middle layer and the upper layer NBFCs. So the criteria which is given under the Companies Act or LODR for the independence of the independent director needs to be adhered to. In additional to that, these are the specific requirements which needs to be adhered to if the independent director is on the board of a NBFC. And the board of the NBFCs should ensure that there is no conflict of interest due to such multiple directorships. However, there is no restriction in the directorships in the base layer companies. So there are certain guidelines on the compensation of the KMPs and the senior management of the NBFCs. As we have already discussed that there needs to be a board approved compensation policy, which includes the constitution of the remuneration committee, principle for the fixed and the variable pay structures, and as Hemant sir has also mentioned that there should be a malus and a clawback provisions in that particular policy, which needs to be followed by the NBFCs only. Now the governance guidelines which needs to be adhered to by the upper layer NBFCs. In addition to what we have discussed already, the NBFC in the upper layer is not getting listed. They should adhere to all the disclosure requirements as a listed entity. and have a board approved policy for the same. So this is it for
Just
today.
add to what Sakshi said, the NBFCs in the upper layer are required to fulfill the regulatory requirements prescribed under BL and ML unless any stringent requirement is prescribed in the upper layer. Similarly, those in the middle layer are required to comply with the provisions given, regulatory instructions given in the base layer as well, unless any stringent norm is prescribed for the middle layer.
Thanks. I think, Sakshi, you're done wonderful. You can stop sharing the screen. It's sharp 11 o'clock and we can close this webinar. What we will do, next session will start at 9:30. Friends, we have to start, otherwise we will not able to give justice to the topic in 1 hour. It requires 1.5 hours. So with this, we'll close this webinar. Thanks a lot. Thanks, Ms. Janani. Thanks, Hemant. Thanks, Mr. San. Thanks, Sakshi, Alifia. Thanks a lot. Ms. Jenny, we are going to invite you again. Thanks a lot, everyone. Thank you.
Ma'am.
Thank you.
Thanks.
Sure.